Rob Walling, the SaaS Playbook. Build a multi-million-dollar startup without venture capital. More than 99% of startups seeking funding are rejected. Most that do secure it still fail. Thankfully, there's an answer. Bootstrapping. So what exactly is that? The practice of building and growing a business using personal savings or revenue generated by your company rather than relying on external funding. This approach is more sustainable because you don't need permission from investors. Your business only ends if you quit, and the main challenge is managing your motivation, not your money. Learn how to bootstrap a tech business using software as a service, or SaaS, as the model business. SaaS benefits from predictable, recurring revenue, economic resilience, and lower reliance on luck compared to speculative ventures like crypto or social media startups. You'll discover the 6 areas to consider when planning for your SaaS success: market, pricing, marketing, team, 80-20 metrics, and mindset. Whether you're a developer, entrepreneur, or non-technical business owner, you'll gain actionable insights to build, grow, and eventually sell your SaaS company. Sustainable success doesn't require venture capital, just a clear strategy and a focus on creating value through thoughtful, intentional growth. The first step is understanding your market. Your product's place in the market. The foundation of any successful SaaS business begins with a deep understanding of the market. A reliable way to gather insights is by having direct conversations with prospects, current customers, and even those who chose not to buy or have canceled their subscriptions. Many entrepreneurs avoid these discussions out of fear of hearing negative feedback, but these conversations are essential for refining your product roadmap and ensuring it solves real customer problems. When speaking with these groups, ask meaningful questions. Pay attention to any frustrations expressed about existing tools or processes. When the time comes to implement suggestions, though, you don't actually need to integrate all of them into your product. Customers often struggle to envision solutions beyond what they already know. Henry Ford is famously and falsely credited with saying, "If I had asked people what they wanted, they would have said faster horses." So when evaluating feedback, consider whether the idea fits your long-term vision, how many users will benefit from it, and if it solves a meaningful problem. Stay focused on your vision while assessing feedback, and you'll be on your way to building a sustainable product. As you're building it, you'll need to find its place in the market. In competitive markets, which most of them are, standing out can be tough. Some companies compete by offering lower prices, while others differentiate through creative sales models such as freemium plans or personalized demos. Another way to compete is by developing a product that offers a superior experience and features. How you compete depends on your product. You may need to get creative about it. Once you've fought your way into the market and established a strong position, it's time to build a moat around your product. Moats are things that make it difficult for competitors to unseat your product from its high ground in the market. These moats include integrations with other software, a strong brand, owned marketing channels, and high switching costs. Unique features alone won't protect your business for long. Long-term success comes from making your product indispensable. With a solid understanding of the market in place, your next step is to create a pricing strategy that aligns with your goals. We'll cover that next. Finding the sweet spot for pricing. If at least some of your customers aren't complaining, you're probably not charging enough. A little friction around pricing is healthy. It shows that customers recognize the value they're receiving and ensures your business isn't underpricing its product, which could erode profitability and sustainability. Pricing too low can hurt your SaaS business by signaling lower value to customers and making it harder to cover acquisition costs. Confusing pricing tiers can also overwhelm prospects, reducing conversions. A thoughtfully chosen price not only communicates value but also impacts customer retention. Research shows that $50 per month is often a sweet spot, low enough to reduce churn and substantial enough to ensure customers are invested in your product. For more specialized SaaS tools, pricing is usually higher. Products in niche markets with longer sales cycles or those requiring demos are often priced at $250 per month or more. SaaS solutions that involve a high-touch sales process with multiple calls or personalized onboarding, might charge closer to $1,000 monthly. At the enterprise level, where custom implementations and deep integrations are standard, prices can climb to $30,000 per month. Understanding where your product fits will help you produce an informed pricing strategy. To determine where your tool belongs, compare your product not just to competitors' features, but to how they position and sell. Segmenting your customer base can also reveal usage patterns and help develop expansion revenue, where customers pay more as they derive greater value. Make sure you're charging enough for your most valuable users, the enterprise customers, since they tend to generate the highest margins. Revisiting pricing every 6 to 12 months is good practice, especially as your product evolves. Price increases should aim to grow monthly recurring revenue, MRR, by at least 10%. Otherwise, it's rarely worth the risk of alienating existing users. A smart approach is to keep current customers at their old rates while adjusting prices only for new users. With pricing in place, the next step is to focus on marketing strategies to attract and retain the right customers. Turning strategy into sales. Building a great product is only part of the equation. It won't automatically sell itself. Many founders are naturally drawn to product development and shy away from marketing, but understanding marketing is essential, even if you plan to hire someone for the role. Having a solid grasp of the fundamentals ensures you can assess whether your marketing efforts are on track and delivering results. The best course of action is to create your own marketing strategy before outsourcing its implementation. This helps you develop clarity about your product's value, ideal customers, and the best way to connect with them. When strategizing, you need a solid understanding of the marketing funnel, which maps out the customer journey from initial awareness to the final purchase. The funnel typically moves through stages such as awareness, consideration, decision, and retention. High-touch funnels for premium or enterprise-level SaaS involve more personal interaction, like demos or consultations, while low-touch funnels for low-price point SaaS rely on automated processes such as content or free trials. If you want the ultimate in-funnel strategy, consider something called the dual funnel. In this strategy, you use both low and high-touch funnel strategies, where the low touch gives you the benefit of keeping customers flowing in and getting the word out about your product, while the high touch connects you with the big fish you really want to go after. Signwell is a great example of this. It had a broad customer base ranging from people who just needed a few documents signed here or there to enterprise-level businesses needing thousands of e-signs per month. Generally, with this strategy, you'll start by seeing the majority of your revenue coming in through the low-touch funnel, but gradually shifting as you build those high-touch connections. When it's time to execute your strategy, there are several marketing approaches you can choose from. Options include SEO, PPC, that's pay-per-click, advertising, cold outreach, content marketing, integration marketing, and dozens more. To select the right approach, you need to evaluate 3 factors: speed, cost, and scalability. For instance, SEO is cost-effective but takes time to show results, while PPC offers faster outcomes at a higher cost. Cold outreach works well for specific audiences, but scaling it may require additional resources. To find what works best for you, experiment while staying focused. Adjust one variable at a time, whether it's messaging, audience targeting, or ad placement, so you can accurately measure what drives results. Spreading efforts too thin or making too many changes at once can lead to confusion and wasted resources. Now that we've covered your product, price, and go-to-market plan, let's talk about something a little more human: building your team. Giving away your hats. At the start of a SaaS business, entrepreneurs often wear too many hats, handling everything from product development to marketing, sales, and customer support. While this hands-on approach is necessary early on, to scale your business, you'll need to build a team. The key to effective hiring is assigning roles rather than tasks. Instead of looking for someone who's a jack of all trades, focus on specific skill sets. Common departments in SaaS include product management, design, engineering, marketing, sales, customer support, finance, and legal. Clear roles help ensure each new hire has a defined focus and contributes to your company's growth. A common challenge you'll face is deciding which role to delegate first. Start by grouping your tasks under relevant roles and departments. Then, evaluate which areas you're least skilled at or don't enjoy. These are often the best places to start hiring. For example, if marketing feels overwhelming, it might be time to bring in a dedicated marketer. Once you know what role you're hiring for, it's time to write the job description. A quick tip for standing out in the job market is to treat your job description like a sales letter. You'll want to do two things that seem quite contradictory. First, you need to be different from everyone else out there, but at the same time, the same as everyone else. How's that possible? Be different by expressing who your company is, its unique flair, personality, and challenges. You probably want to attract someone as scrappy and up for the challenge as you are, so express that in your description. But it also doesn't pay to be too cute. Some things need to follow industry standards because that's how people search for jobs. For instance, when it comes to job titles, it can be tempting to just invent your own title like Chief People Person for a sales representative or Director of Answering Phone Calls for an accounts manager. While this seems fun, it's best to use standard SaaS job titles along with standard language about responsibilities, expectations, and compensation. This makes it easier for candidates to find your job postings and allows you to benchmark your roles against the market. Once your team is in place, treat it like a professional team, not a family. Teams have clear roles, accountability, and healthy boundaries, qualities that promote better collaboration than the informal dynamics of a family. Besides, people know you're not a family, and saying otherwise comes off as disingenuous. Next up, how to measure your success. Measuring what matters. Without metrics, there's no way to know whether you're headed toward your goal or falling behind. Metrics not only show you what's happening in a moment in time, they also help you put together trends and a framework for testing and optimizing your product. You simply have to follow the right numbers to understand both your current performance and future growth potential. In SaaS, two of the most telling metrics are MRR, that's monthly recurring revenue, and month-over-month growth rate. MRR shows how much predictable income your business is generating, while growth rate reveals how fast your company is scaling. Both are lagging indicators, meaning they reflect the results of past activities rather than predicting future trends. To get a full picture of your company's health, you could adopt the 3 high 3 low framework. This provides insight into where your revenue is headed and helps identify signs that growth might plateau. Key low metrics to monitor include CAC, that's customer acquisition cost, sales effort, and churn. CAC measures the cost of acquiring each of your customers. Sales effort evaluates the time and resources needed to close a deal. And churn, or the percentage of customers who cancel, is a signal of long-term customer satisfaction. Equally important are high metrics like ACV, that's annual contract value, expansion revenue, and referrals. ACV reflects the revenue generated per customer per year. Expansion revenue shows how much existing customers are spending beyond their initial subscription. And referrals indicate customer satisfaction and are a powerful driver of organic growth. Let's go back to churn for a moment and talk about the North Star for this metric. First of all, if your product is priced too low, you may see higher churn rates. Lower-priced customers tend to have less commitment and are more likely to leave, so this is a quick issue to address when attempting to lower your churn rate. Ideally, you want your churn rate to fall between 0 and 3% to maintain healthy growth. But the ultimate goal for every SaaS business is achieving net negative churn. This happens when the revenue you generate from upselling or expanding services to existing customers outweighs the revenue lost from cancellations, even without acquiring new customers. With net negative churn, your business can grow organically, building on existing relationships and creating a self-sustaining revenue loop. Achieve this dream metric and your business will be set up for success. By tracking these metrics, you can gain insight into the health and sustainability of your business. Each number contributes to a clearer understanding of how efficiently your company is operating and where it's heading. In the next and final section, you'll learn about the mindset you need for long-term success. Cultivating mental resilience. Building a successful SaaS company requires a combination of hard work, luck, and skill, but only two of these are within your control. While you can't predict or manufacture luck, the right mindset will ensure you maximize the impact of your effort and abilities. One essential mindset shift is learning not to turn speed bumps into roadblocks. Every entrepreneur faces setbacks, whether it's a product glitch, a marketing misstep, or a customer issue. The key is to treat these challenges as part of the process, adapting and continuing forward rather than letting them halt your progress. Another way you can support yourself is by surrounding yourself with the right community. Being a founder can be isolating, so finding a network of other entrepreneurs who understand the challenges is invaluable. Peer communities provide support, accountability, and fresh perspectives. Connecting with fellow founders, whether through online groups or in-person meetups, can give you the encouragement needed to get through tough times. Burnout is a real threat for founders who are deeply invested in their startups. To avoid this, integrate mental health strategies into your routine. This can mean setting boundaries between your work and personal life, taking regular breaks, or building habits that promote well-being. Ultimately, success is about consistency and resilience. With the right mindset, you can work hard, leverage your skills, and stay open to opportunities when luck comes your way.